The Indian stock market in June 2025 has defied expectations. Even as global tensions escalate due to the ongoing Iran-Israel war, domestic markets like the Sensex and Nifty 50 have remained remarkably steady. Many expected panic, volatility, or at least a broad sell-off, but what we are seeing is calm, composed market behavior. On May 7, the Sensex was holding strong at 80,710 and the Nifty was at 24,403, barely reacting to what's being called the most dangerous geopolitical standoff of the decade. So what's going on? Why are Indian markets so resilient even as global oil prices fluctuate and headlines scream war? To understand this better, let's look at how Indian markets have reacted historically to geopolitical events. When we compare past conflicts like the 1999 Kargil war, the 2001 Parliament attack, the 2016 Uri strike, and the 2019 Pulwama incident, the pattern is clear. Initial dips are usually shallow and recovery tends to be strong. For example, during the Kargil war, the Nifty dipped just 0.8% and then surged nearly 30% over the next 6 months. In the Pulwama case, the market dropped only 1.8% but gained over 12% shortly after. Even now, amid the Iran-Israel conflict, the Nifty has only declined about 1.3% and is already stabilizing. This historical trend reinforces the idea that markets react less to war headlines and more to long-term economic fundamentals. One of the biggest reasons for this resilience is India's strong domestic demand. Our economy is primarily driven by consumption, which makes up nearly 60% of GDP. That insulates us from global shocks like the Iran-Israel war. While countries heavily reliant on exports or foreign capital flows might wobble, India's internal economy remains solid. In fact, sectors like retail, FMCG, and autos continue to post healthy numbers, aided by a good monsoon season and robust festive demand. Since Iran and Israel together account for less than 1% of global GDP, their direct trade impact on India is minimal. Another major stabilizer is the Reserve Bank of India. On June 6th, the RBI delivered a surprise 50 basis point cut in the repo rate, bringing it down to 5.5%. Alongside, they slashed the cash reserve ratio by 100 basis points to inject more liquidity into the system. These proactive steps signal to the market that the central bank is ready to cushion any economic fallout. More importantly, these moves help companies lower borrowing costs, spur credit growth, and maintain investor sentiment, even amid global uncertainty. What's also helping is India's reduced dependency on crude oil from Iran. Ever since sanctions and payment issues emerged a few years ago, India diversified its oil sourcing significantly. That strategy is paying off now. Unlike in 2006 or even 2012, when West Asia tension caused oil spikes and rupee depreciation, the situation today is different. While Brent crude has touched $61.75 per barrel, it's nowhere near panic levels. And India's foreign exchange reserves provide enough buffer to absorb shocks. Investors too have matured. Today's market participants, especially retail investors, are far more experienced and data-driven. Many have lived through past events from 9/11 to COVID and have seen how quickly markets can bounce back after crises. As a result, panic selling has reduced, and what we see instead is buy the dip behavior. Social media is filled with posts from traders and analysts alike encouraging systematic investing, especially through SIPs. The collective mindset seems to have shifted from reacting emotionally to taking a longer-term view. From a global perspective, it's also important to note that the Iran-Israel conflict, while serious, has not yet spilled over into a broader regional war or affected global supply chains in a big way. US and European markets have remained stable. In fact, Japan's Nikkei and South Korea's Kospi posted gains in early May, which sends a signal to investors that this conflict for now remains contained. That calming effect globally translates into less panic domestically. Institutional flows are another reason why markets are not falling. Foreign institutional investors, FIIs, have pumped in 43,940 crore in the past few weeks. At the same time, domestic institutional investors, DIIs, continue their strong support through mutual funds and SIPs. In a way, whenever FIIs sell on fear, DIIs are stepping in to buy the dip. This balance creates a strong demand flow that stabilizes the market and reduces large corrections. Sector rotation is also playing a role. Investors are moving funds into safer domestic focus sectors like defense, utilities, and banking. Defense stocks, for instance, are benefiting from rising global tensions and India's growing emphasis on indigenous defense spending. Meanwhile, consumer staples, power companies, and public sector banks are proving to be safe havens during this time. These sectoral inflows offset the pain in tourism or aviation stocks, which are more globally exposed. India's macro fundamentals are another key layer of support. GDP growth for FY25 is expected at 6.4%, which is one of the highest among large economies. Inflation is under control and remains within the RBI's comfort zone. The Indian rupee, while slightly volatile, is largely stable around 85.70 to 85.75 per US dollar. These factors create a solid base for investor confidence. In contrast, markets like Pakistan have seen a sharp 5.5% drop during the same period, highlighting how local fundamentals matter more than shared geography. Lastly, it's worth noting that many analysts believe the geopolitical risk is already priced into the market. As tensions between Iran and Israel had been brewing for months, investors had time to adjust portfolios and rebalance exposure. So when the actual conflict broke out, there was no knee-jerk collapse. Instead, Indian equities have absorbed the shock and continue to trade in a narrow, stable range, waiting for clarity but not panicking. In conclusion, the Indian stock market's calm during the Iran-Israel war is not a coincidence. It's the result of strong domestic consumption, timely central bank action, reduced oil dependency, sectoral support, and investor maturity. For Indian investors, this is an important lesson in not letting global fear override local fundamentals. It also underscores why staying invested during volatile times often pays off in the long run. Whether you're a retail SIP investor or a long-term equity holder, the message is clear. The market may wobble briefly, but the foundation remains firm.